Welcome to the Audit Opinion, the podcast where we tackle some of the top of mind issues and opportunities that are facing accounting firm leaders. I'm your host, Mark Edmondson, and today we're diving into a topic that's a key discussion and a debate in many accounting boardroom nowadays. And this is around the future of the firm when it comes to remaining independent, exploring outside capital like private equity investment, or considering perhaps being acquired. Now, to help unpack the pros and cons of each of these approaches, I'm joined by Bob Lewis from the Visionary Group. Now, Bob brings a wealth of experience advising firms through these pivotal decisions, and I'm really excited to get his take on what leaders are thinking about right now in this incredibly exciting market. So, Bob, let's get straight into it. From your vantage point and the work that you do and the relationships you have with so many firm leaders, how are you thinking about, how would you describe the current strategic landscape for accounting firms?
Okay. So just for the audience there, really quick, I've been doing this for 30 years for accounting firms only. All mergers and acquisitions help these firms organically grow and stay independent. What's challenging right now for their landscape is about 4 or 5 years ago, private equity crept into this market. First time ever in accounting firms. All right. First couple of years of that were, I'll call smaller private equity groups for the most part. There was one large material investment from a larger group, but then smaller private equity groups started acquiring firms. Now, if I go back about 2 more years, about 2 years ago, some of the larger firms started accepting outside capital. There's a big difference here. Now, what the challenge is created is it's raised pricing and deal structures all across the board. There's more cash. The traditional way a firm was purchased or merged upward has changed completely. And there's more competition looking to acquire because as these firms get bigger and bigger, they have more leverage, more investments in place that they need to leverage out. So they need more and more firms to put underneath them. So some of it is a quest or a race to get to a bigger EBITDA number, to maybe what we call flipping to a second level of private equity, or some call it a liquidity event, which is kind of a little higher end. Liquidity event requires more like a glass of bourbon. Flipping seems more like a glass of beer, but it's the same outcome. So the landscape here is we also now have combined this with the artificial intelligence tsunami that's coming at everybody, figuring out how they're going to manage it, how they're going to afford to do it, can they even manage it? And capped off, I guess, sticking with our alcoholic beverage drink, the cherry on all of this inside the nice old-fashioned bourbon, I've got average baby boomers at 69. So the succession problems running rampant in these firms is huge. We've got firms that are forcing themselves into doing a merger or acquisition or looking at private equity or outside investment because they've run out of runway with being able to develop their own succession plan. So when you add these all up, it's really fueling the marketplace right now. So
Really fascinating. It's really fascinating what's going on and the kind of the combined effect of some of these different things. Let's focus the conversation first and foremost on the more traditional model, the model that's been in place in the accounting profession for a long time, and that's effectively being independent, or in this world now, staying independent might be the way that we phrase this. So what do you view as being some of the key advantages to the firms that are remaining and intending on long-term staying independent in the market?
Well, the advantages are, of course, that there's an increased perception that if I remain independent, I have a much better chance of controlling all the shots. That's one of the biggest fears of not being independent is I'm going to merge into your firm, Mark, okay? And I now have to follow your rules and your regulations, and I've lost control. That's really not true. If you make a bad decision merging up into somebody, that will happen. But most of these firms, like Mark, if you were looking to acquire a Visionary Group, which would be interesting, a very interesting merger of two different, very distinct groups, you'd be looking to me to expand and grow and to be entrepreneurial. What you're going to provide me is more tools, more resources, maybe more finances, more people, access to things I can't develop on my own. So the firms that are looking to stay independent, the big thing they need to look at first is they need to what we call stress test their succession plan. Every firm has a succession plan of some shape. Some have it written down, some have it in implementation stages. Some have never shared it with their staff. So, you got to really look and go, is this really a succession plan, or is this more like a succession wish list of things I'd like to put together, but I don't think I can pull it off? To remain independent, though, to us, the key thing for all of this, you have to look at the clients. The clients dictate every single action going on inside the firm. So if I have clients that are burning up capacity, I have clients that are under realized in terms of how they produce from capital to the firm, that dollars per hour kind of approach. I'm taking my existing resources and applying them to clients that either don't value what we do or the wrong size fit type of client. And I need that money. We call it internal capital. I need internal capital from those clients to be able to bonus my staff, to invest in technology, to make more profits for the leadership of the firm, and to build firm value. And if I'm not looking through that process and I don't have the strength to actually take those actions, I've got a lot of D clients, a lot of C clients. Why am I doing that? But that's how these firms need to remain independent, because otherwise the firms around them are getting bigger. They've got more resources. Also, Mark, I'd have to encourage two other things. They need to invest heavier in technology and use it. And they have to invest in offshoring, because a lot of firms are resisting offshoring because it's not the same quality or the right mix. Reality is, I don't think that's an option to continue to push off if you're a smaller firm trying to remain independent. And what's a small firm, by the way? It could be anything under, I'm not talking about $1 million, $2, $3 million firms. I'm talking about firms that are $10, $15, $20 million. They're competing now against firms that are hundreds of millions of dollars. And that's a difference in how they have to play the game.
I think the questions around remaining independent are way bigger than smaller firms. I think that they transcend the whole profession. We've seen that some of the biggest firms in the market have explored alternative capital structures here and sought external funding to be able to go bigger. And so I don't think necessarily this is a small firm mindset anymore. This is a conversation that's happening in the biggest of firms.
No. Well, the other part of this too, Mark, is just look at value pricing. It's a kind of a vague word you throw out there, but here's an easy one. So let's assume you're an accountant and you saved me $250,000 and it took you 30 minutes to do it. All right. How do you charge for that? That's a common thing we talk about when we do events. Pricing. How do you charge that? In a couple of the events, it's broken out as spontaneous, almost fights in the audience about, well, you should only charge for half an hour because it's unethical to charge for more than half an hour if it only took you 30 minutes to do it. Other people whipping out, you should charge them $75,000. Point is, look, when we do a letter of intent, like if I look at a letter of intent in an M&A deal and have Master review it, I can take that letter of intent in 45 minutes to an hour and pull it apart. Doesn't mean it's bad, but I can pull it apart. I can add what's missing. I can go into terms that are, I think, weak or vague. I can show like value points, but it takes me 45 minutes to an hour. Okay. It took me 30 years to figure out how to do that in 45 minutes to an hour. And, you're charging for what not the time it took you to get there. Because if I charged for the time it took me to get there, that'd be about a $4 million bill. Because if I added up all the hours to figure out how to do that, it's a gigantic bill. You have to find somebody to pay me $4 million to look at a letter of intent. But if you've got one, Mark, send them our way. That's prevalent through this entire profession. We undervalue what we do because the accountants just assume that this isn't complicated. Here's a trick to all of this independent stuff, and really all of it, period. People think they're selling tax returns on accounting and audits. Okay. What they're selling is the relationship, because if the client could do a tax return themselves, they wouldn't engage an accounting firm. So if they can't do a tax return themselves, they have no way to question the value of the accountant that's providing the tax return. So they're basing the entire relationship based on how we interact. Maybe it's pricing or communication or whatever that creates the tone with me. The accounting is pretty much the same way. Audits, I'll give a little more leeway if I've got a really good CFO or controller. He or she's going to be able to go, That's a really good audit firm. They're not cutting corners, but most organizations, when they engage in audit, and I'm not talking about the big four kind of clients and the really super large clients because they have sharp people looking at that. They don't really know if they're getting a good audit. They don't know if they're getting a good tax return. It's all about the relationship. That's what we're selling. We are literally in a relationship business, but we think we're selling financial services. That's, I think, the disconnect in a lot of firms. Like clients don't care about compliance deadlines. They don't care about, regulatory pieces or new changes in law. They just want they want you, if you're an accountant, to assume you know how to use those and what to do with them. And they have no basis of being a challenge if you didn't do it. So it's an interesting business that we're in. And most people don't understand it. We are selling relationships, not products like Coke or Pepsi or whatever, where I can literally taste the difference between Coke or Pepsi, or take your pick of any cola, and develop a particular taste for it. So that's what we see. Pricing, there is no price ceiling either, by the way. In the large firms, the super large firms, there's a price ceiling because they're dealing with large, Fortune 500 companies, Fortune 1000 companies. You look at the middle of the pyramid, the base of the pyramid, accounting firms should be charging like crazy. And if they overcharge to a point where the client doesn't like it, they already have a capacity problem. So what are we losing? And as they look for new clients, they should be bidding high, because why give the service away if you've got a capacity constraint already?
Let's talk, Bob, around what are some of the potential advantages or opportunities that are brought by exploring outside capital for the firm that's beyond the traditional partnership model and partnership funding structure?
So part of the reason this is all happening too is, at least in the United States, and I believe it's pretty much across the globe, there's really, most of the retirement programs in firms are unfunded. So we have a deferred compensation program where I'm going to get paid X amount of dollars over the next 10 years when I retire, but that's an unfunded liability. So it's also causing the opportunity for me to go in and go, does it make sense for me to accept outside capital to maybe resolve that debt? Or do I go into a private company equity situation? There's a difference between majority and minority investments, huge difference. And currently, most of the transactions that have been occurring up until last year have been more, I sell a majority of my firm. I'll sell 55, 60% of it. We're starting to see some minority investments, like the one I just referenced was about 20%. The problem with some of the minority investments is, and this will change, a lot of the investors want to have a minimum of, like, I don't want to invest less than 25 million into the firm. Okay, so if I'm going to give you 25 million, Mark, for the investment, let's just say the firm's selling it 1 times revenue, which is not the way to look at it. Let's say it's a $75 million firm and it's just worth $75 million. And by the way, if anybody's listening to this and it's a $75 million firm who's getting a $75 million quote, please call us, because that's way under market. If your firm's 75 million, I have to give you 25 million a minimum. I'm going to buy 33% of your practice. The condition here, though, is typically I will have the right now to call that back in 4 to 5 years. Okay, so I can execute on you, who I've given the 33% investment cash into, to go, well, Mark, now I need to liquidate. So if our $75 million firm is now worth 140, you have to pay me 1/3 of a $140 million value firm, which is probably going to force you now to go to a second event and sell a majority off, or I'm going to come to you and buy a bigger piece of your firm. I think a lot of the gamble here is, how long will it be before there's a flip or liquidity event that occurs inside the firm? So you may be taking that note going, it's okay for me to take it for 3 or 4 or 5 years, because I think we're going to be gone in 2 or 3 years to the next level. A lot of that is happening right now and kind of unfolding in the market. But right now, there's really been very limited amounts of second flips or second liquidity events. Very, very small. We expect a lot to happen in the next 6 months to a year, but that is still a little bit uncertain.
Could you maybe list 3 or 5 things that you think the leadership team should be laser focused on in terms of the metrics?
Okay, this is what we look at, and there are more than 3 or 4 or 5, but these are the key ones. Okay, first thing we look at is, what's the revenue per professional head? So how we calculate it, and firms will calculate this a little differently, but I want to be clear with the formula. So if I take a $10 million firm and it's got 50, that's 50 full-time equivalent employees. And what I want to make that clear is staff accountant to managing partner. So I leave the admin people out of this equation. I leave any offshoring out of this equation. Okay. And those two pieces will change the formula. But the first thing we look at is that core one. I've got $200,000 revenue per professional head. That's kind of like a benchmark, like line we put in there going, okay, if you're at $1.75, $1.50, or we've seen them as high as 550. Okay, 550,000 revenue per head. I talked to a firm the other day, was close to 600. It's just, and we thought, the first thing we see sometimes when your revenue per professional is really high, is I go back and go, well, Mark, you're billing 3,000 hours a year, and your two partners are billing. Okay, that can artificially inflate it. But if you're billing like 1,000 hours a year, and your other partners are billing 1,000 hours a year, that's a leveraged firm. Okay, would it be better if you're like 750 hours a year? Yes, but you're not at 2,000. That's our first core metric we look at. And the reason why that's critical is, let's say Mark, you're at 275, and you're going to look to acquire my firm, and I'm at 175. That's a big gap, right? I look at that as a buying opportunity for you. You can bring me in. If you can get me to 200, and I got 50 people, you just dropped an awful lot of money to your bottom line. And if you get me to 2.25, even better, right? You've already done it and made the investments. The second thing you look at, huge, is realized dollars per hour. People get confused. They look at realization and they go, because the reports all say realization percentages for the most part. So they'll walk around going, well, I'm at 100% realization. Of what? I would rather be 60% realization on $1,000 an hour than 100% realization on $200 an hour. The math is really pretty easy. So you need to look at the realized dollar per hour and figure out, are we value pricing right? Are we charging right? And a lot of firms, unfortunately, are not they're under $200 realized dollars per hour. And then we look at that same metric fully loaded. So right now, when a realized dollar per hour is calculated, it's just the billable time and the billable hours. What about your non-billable time? What about the admin time? We add that all in. So we look at 3 different cuts of the number, I realized dollar per hour. Often that cuts about 50%, by the way. So if you were at $200 an hour, your actual realized dollar per hour firm-wide is probably 100. That's pretty normal, okay? Then you have to look at your fully loaded cost and go, what's my margin really? How can I tweak that margin? But we look hard at utilization, because everyone says they're overbooked. I got no time to breathe. Yeah, utilization's 55% almost across the board, every single firm we talk to. When we look at the information, pull all the data down. So that tells me somebody's not putting their numbers in the system, or we're not sure where that time is disappearing to. Then we look at AR, okay? Because we see firms that are really good at doing the work and amazingly horrendous at collecting it or getting it out of WIP into billing even. Like, it takes me 2 months to get it out of WIP into billing, another 6 months to collect it. And, so I've given the client 8 months of cash. Worse is, I got an AR open with you, Mark, of $250,000. You owe me $250,000. And I start your work for next year. Okay. So you're appreciating it greatly, because I'm doing work for you basically for free and letting you use my money as a loan. The last thing we look at hard is write-downs and write-ups. So when we look at that, we break it down by department and by partner. And what we often find is there's a couple of partners that are really good at writing down revenue and really bad at writing it up. And we create this like little bell chart, and we put the partners' names on there, and sometimes they get all aggravated, but it is what it is. You can't fix the problem unless you identify what the problem is. And maybe it's not a problem. Maybe those partners were given very bad jobs to work on, like we underpriced it or whatever. So if that's the case, in my realization, my write-downs are huge and yours are not, we have to look at my clients and go, maybe these aren't the clients we need to have in the firm anymore. And that's what's causing me to write this stuff down, because we underpriced an audit or we underpriced a job. And I'm the smartest guy in the firm, so you gave me all the hard stuff to do, and it was really bad work. So just because a partner has bad results on the report doesn't mean it's a bad partner. It just means we may need to realign what that partner's working on. And when you show this information, we also have this really cool thing we call the red dot analysis. So we data map out all the green dots, which are over 100% realization, yellow dots, 80 to 100, red dots under 80% realization, And recently, because one firm added this because of their performance, we have the black dot, which is under 60% realization. And you scatter map these clients all out there and you go, why are we working on the blacks and the reds? What do we do about the yellows? Okay. And those are big numbers, by the way. They're huge numbers of clients. And if I could just take a yellow and convert it to a green, and I could take a red and convert it to even a yellow, huge progress. And then I have to look at the black dots and go, do we even want these as clients anymore? How do we even get them? The big thing is that it identifies what are the really good green dot clients you want. Like you'll have some client that's $50,000 or $400 an hour. How do you get that client? Are they in an industry or niche we want to go after? Is our marketing aligned to go after those kind of clients? Are our conversations with referral partners in line with that? That's something most firms just don't take the time to look at, and it's huge. But those are the metrics you look at, and it is eye-opening. And if you want to look at that and go, wow, we're burning a ton of like our capacity and time, that gives you the tools to go back and go, this is how we can create the internal capital. If you create internal capital, whether you're owned by private equity or outside investment, or whether you're trying to stay independent, it's just extra money inside the firm that should exist.
Because a lot of the press coverage when a firm takes on private equity investment is all about, we're going to be investing in technology, we're going to be investing in this, that, and the other. There's almost like this association that I can only achieve some of these things because of the private equity money. So a good one is, for example, moving to a C-suite model and moving away from a partnership leadership structure. Because every private equity firm who makes an investment pretty much then implements the corporate C-suite model to the partnership because of the changes in governance and because of the ways that they put the alternative practice structure in and things like this, people associate moving to a C-suite structure to improve decision-making as being a private equity thing. And it's completely not. It can be done if you're an independent firm. It might cost you a little bit of money to put some C-suite people in the table, but the whole point of it is that you hire somebody who's going to get paid $200,000 to $300,000 to be amazing at marketing or amazing at people strategy, etc. And because of that, you win 6 times as much more work from better marketing efforts, or you've got a better people team, etc. So I think just for me, some of the things have been almost the association of things that you could absolutely do if you're independent as being private equity type things when they're just not. And I've shared a few examples of firms that have done some great things around leadership models, around offshoring, around technology investment. They're 100% independent. These opportunities are in the market. And what I think is really exciting is private equity investment is giving you all the validation you need that the accounting profession is exciting. Because I'll let you in on a secret. People only invest in things if they think they can make money. And so the option for you is, do you want to make money now? Or do you want to make money down the line? And how much do you want to do this? And how much entrepreneurial spirit do you have? Because the more entrepreneurial you are, I'd say the more you're going to kind of explore the different options here and you're going to go hard at them because the market is full of opportunity. So whether you go down private equity or whether you stay independent, for goodness sake, take advantage of the absolute huge opportunity that's in front of us in the profession by being deliberate on one of those two strategies.
The big message we leave people when we present, we speak all over the country, okay? The last slide we always put up there is, no matter what you do, the option is not to remain and just do nothing. That's not an option in this market. Things are just changing too much. So we're big fans. If you ever seen the movie Mark Moneyball, in Moneyball, in the Oakland Athletics baseball team competing with $40 million against $120 million Yankees and Red Sox, right? How do they compete playing the same game with a third of the budget? That's how firms need to start thinking. If you want to remain independent and you're a $5 or $10 million firm, I'm competing now with a $50, $100 million firm who can kind of eat my lunch and in a rounding error take my profits away. You can do it. You just have to play the game differently. You can't continue to do what you've been doing. Otherwise, it's a downward spiral. Eventually, you'll get caught it. But that's where firms run out of either bandwidth, and to be blunt, a lot of the leaders, I've had people come up to me that run these firms go, I'm the quote unquote, this is a Chicago thing where I'm out of, I'm the guy, lady, sorry, or just a Chicago term. I'm the guy is universal for men or women in Chicago on that. I'm the guy that got us to 5 or 10 million. I'm not the guy that can get us to 20. It goes beyond my depth of ability to do that. And that's a hard conclusion for a lot of leaders to come to, or they need another one just like them and they can't find that unicorn in the market. And then the firm begins to flatline. And we see firms flatline at 5. We see them flatline at 1, 5, 10, and 20. Big flatlining. Okay. The reason why in the US there's 45,000 accounting firms with like 43,000, $1 million or less is because it's just me or just you, Mark, and I got 2 or 3 people. And we just can't get beyond that. And because you have to invest a lot to get beyond each of those different plateaus. And sometimes firms just don't want to make that investment, or owners don't want to make it, or it just exceeds my ability or my comfort level. Is the private equity as advanced in the UK as it is in the US right now?
It started.
I think it is. Yeah, what I'm hearing.
Yeah, it started earlier here. We've got a lot of investment over here from private equity, from the biggest, top 10 firms taking that on more recently, shall we say. We've also got some firms in the UK taking on, being merged with the US counterparts of their firms. So some really interesting things going on here. But I'd say the UK market started earlier, is a bit more progressed than where the US is. But I don't think it's going to maybe play out as being quite as pervasive where it gets to come the end of this. And by that, I mean, I think we're going to have over here a stronger contingent of firms who remain independent longer term. What I'm seeing in the US is, while it was a bit slower to get going, it is far more aggressive what's happening over here. And the level, over here, I'm based in Florida here. What's happening here in the US is something that is taking on significant momentum. The wave here that's happening, I mean, you look at it and go, I think there's going to be more firms who are backed by private equity than are not backed by private equity if I fast forward in the not too distant future. And that's a bit different, I think, to where the UK is right now and where I think it'll end up. What are you hearing from firms in terms of like how they view the end game here? What is the ultimate play that maybe survives you and I in this profession, but comes after this wave that we're seeing right now?
All right, it's not a complicated thing, but we get this question all the time. Like, what's the end game? So we can put all the money in, and how's it going to end? Okay, so end game 1 is I'm going to purchase your firm initially, Mark, or some percentage of your firm. We get to a right adjusted EBITDA number. I'm going to use a multiple of 7. It could be 6. It could be 5. It could be 10. It could be 12. Okay, variation on the multiples. People get hung up on the multiple. That's only a piece of the equation. Let's just say, for argument's sake, I'm going to buy 70% of your firm right now at a multiple of 7, whatever the EBIT is. Fine. Okay. You're going to work with me. We're going to grow the EBITDA. We're going to put all these firms together, grow the EBITDA. And ideally, we take, instead of having your $10 million firm and my $7 million firm, now we have part of a group that's $200 million, right? So that $200 million group can make more investments in helping each of us get more profitable. And eventually that $200 million firm group, or 300, may sell to the next level and go at a multiple of 14. So the end game is, I'm going to buy you at 7, sell you at 14. I'm going to get, if I'm the private equity company, I'm going to get your first 70% at double multiple, right? Because I bought you at 7, I'm going to sell you at 14, but you're also going to get on the 30% you kept the increase of another 7, which you couldn't do on your own. That's one end game. But the bigger piece is, how are they going to grow the EBITDA? They are going to bring in the automation. They're going to bring in the processes and then the offshoring and whatever, and pricing strategies. But here's another part that everyone's missing. Most firms do an absolutely horrendous job of selling advisory services into the client base. So if I'm one of the larger private equity companies waiting to buy our newly formed $200 or $300 million firm, I'm going to buy our new $203 million firm up there. And I've got an insurance company. I got a tech company. I got a wealth management in place. I can drop all those pieces into those thousands and thousands of clients inside those TPA firms we just acquired, or accounting firms we just acquired, and cross-sell services that none of us could have done on our own. To me, that's a massive end game. And if I look at the real end game, I'm going to convert a lot of these clients that are older, and that average baby boomer 69 just doesn't apply to accounting firms. It's the clients too, right? I'm going to liquidate them. I'm going to drop them into my wealth management arm. I'm going to drop them into my family office, and I'm going to take care of the next generation for the next 100 years and make more money off of managing the asset and converting the initial asset from, a compliance client to an investment banking client and then to a wealth management client. I think that's a huge play. And I could sell them insurance every year. And I could sell them all the other things they need to have, whether they're part of a group anymore or not. And that, I think, is the end game, but we're yet to see that completely unfold. And there's some firms in the US right now that are doing a really great job of advisory. Like half their firm's revenue, a large firm, is advisory, or they're deeply niched in an area like healthcare or whatever. But most firms can't get to that point.
And in that example, so we bring this together, we were able to create a more attractive firm in terms of the multiple's going to be higher, the profit level's going to be increased. We're going to leverage a lot of the capabilities that we wouldn't have been able to do individually. We're flipping it to somebody else, right? So how does it, do we just keep flipping to somebody bigger? It's moving up the chain. Like, how do you see that playing out?
Good question. My ultimate joke on all this is eventually we're all going to be owned by Amazon, and your accounting results and tax return will be delivered the next morning. But I do believe that is the cycle. We're going to go into bigger and bigger entities, okay? And then as that happens, and Mark and you and I spend our 5 years or whatever the commitment is we're required in the transaction we do, we may decide when we go to the next level, cash out, let's open up the Mark and Bob show, okay? Or you know what? Let's just retire, or whatever. It depends on where we're at or how much money we're making or whatever. I think that's what's going to continue to happen. The real question on all this is what happens if there is no second buyer? What's the problem? Okay. So Mark, I'm the private equity people. I gave you $25 million on our earlier example on a $75 million firm, and the firm's growing, whatever, but we can't find another buyer. Now remember, if I've acquired your firm, I just gave you investment before. Let's flip it. You're a $75 million firm and you sell 70% of that firm to me. And I gave you, I don't know, 40 million in cash. I'm making up a number because I didn't take the time to go and actually do the calculation, but I'm going to give you 40 million in cash. And over the next couple of years, you've got another 10 million or 15 million, right? You've taken most of your chips off the table already. So if this thing falls apart and I'm sitting there with your firm in an investment I don't want to be in anymore because I'm a private equity firm and I need to manage and make money off that money, what am I going to do with that? I'm probably going to turn around and try and sell it to somebody else or just to get out, or sell it back to you. So I've given you a huge chunk of money already. I've taken a lot of your risk off the table. Wouldn't it be great to buy your $75 million firm back for like 50 cents on the dollar and go, I'm back to where I started, but I got all this cash in my hand and I'm back with a firm that I had before, which isn't bad. Now you can actually do an internal succession if you want, because not even pay it off. I don't see the downside on the cash side. I just don't see it, unless you make a bad transaction.
No, I think it's maybe, but it's going to happen more to the macro level profession. But based on what you shared there, you could see it potentially being, well, there's a consolidation of the mid-sized regional firms to create bigger national players, and maybe there's no longer just a big four, there's a big five, a big six, or what have you, or there's a stronger kind of, national tier. And then if you get all of these people spinning out and creating niches, you're going to basically have a lot of smaller end firms as well, niche firms. And so it's interesting to see how it might play out, because the other bit that comes up a lot in conversations is also that employee motivation, if you like. And by that, I mean, when I joined the profession, I was sold the vision of one day you could be partner, and look what it's like to be a partner. You have all the money in the world and all this and all that and etc. And I'll put to one side all the kind of views of what that looks like. I was Big Four, so that looked a particular way, right? But what we can see, though, is that the partnership or achieving becoming a partner is going to look very different now in a private equity-backed firm than your traditional partnership would have looked like 10 years ago, let's just say, for simplicity. And so how are you seeing that part play out? So people are excited and want to be continuing their career in a firm like this?
Here's the perception mindset shift that's occurred. When I grew up and when I started to go to, into work, my motto was you work, 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 and then you have retire, right? The norm has changed. That people are looking at the accounting profession going, well, I'm 30 years old. I don't want to work another 30, 35 years and then wait for my deferred comp payout to hit. Now, they may be great money maybe between now and 65, but they're also looking at that going, that may be not what I want to do, and I don't want to be stuck in that track. Now, if I go to an all-set investment-backed firm, or I go to a private equity group, and I've got stock or stock bonuses or whatever, and that's one of the things that the CPA firms in California have been battling with for years. They're trying to get accountants who are going to these high-tech companies getting stock options. When the CPA firm they didn't have it. They didn't have a stock option. There was no way to show anything that had any value. The norms have changed in how we want to operate now. People don't want to work 70 hours a week. The norm before was you work 7, you work with a big 4, you work a lot of hours. The idea was you work a lot of hours, they grind you up, and then when you're done with your grind, you get into a nice job as a controller or a CFO or a public company, whatever you want to do, right? Nobody wants to do that anymore. And so if that's the situation, they've got more of a work-life balance. The other part of it is they also want to wait 30 or 40 years to get paid out. They want to see more money now. And that is part of the problem with balancing the workforce right now. And I know when people talk about culture and you got to be really good to your employees, I don't know any other solution other than the fact that, some of these people hate the private equity. Most of the people, by the way, that hate private equity or also investment do not understand it. They just don't get it. They've not lived in it. They haven't gone through a deal. And I love everybody who comments on transactions, who's never done a transaction in their life. They have no idea how this works. It would be like me putting together a computer for you. It would be the worst computer in the world. It would probably never work. That's the change that's happened on the partnership model is people don't want to wait anymore.
Maybe as we move to close, Bob, just taking it up back to the top level conversations and the leadership mindset that's needed around this, because we've talked about the different options, the different ways people could advance from here, but there's also an incredible amount of synergy across a lot of these things, right? Whichever path we're taking, there's going to be some core themes here. So what are you seeing as the things that, regardless of the path you take, are important from a leadership mindset or from a vision setting or communication piece? What have you seen that's working well? And maybe what are the things that people could avoid making some of the mistakes that you've seen in some of these activities?
So let's talk about the mistakes first, because that's easy. The mistake is stereotyping. Okay. They had a client who went private equity 10 years ago, and it was a disaster because they bought their manufacturing plant and moved it to Mexico, and everyone was fired. Throw the stereotypes away. Open the door. Look at what's out there in the market. Change your mind, your perception of how to just begin approaches. I have firms that are adamantly will not go private equity or take outside investment, but they're talking to them so they understand what they're giving up, or if they're making the right decision, so they're making an informed decision. But if you don't have the conversation, whether it's trying to stay independent or whatever, you don't have a conversation about it, you don't know your options. That's the one thing. Second thing is fear of the unknown. Okay, look, I'm making, I'll be an accountant right now, I'm partner of a firm, I'm making $500,000 a year. I'm comfortable at accountants are known for like calculating things. So like I sit there and go, if I can just make $500,000 a year for the next 10 years, I can then retire and everything's good. What they're missing in the equation is what could change between now and the next 10 years as the whole infrastructure could be different. What's working well in the firms that are looking at this is they're looking at their options. Some are looking at it and going, well, I got to work on my EBITDA before I can take my firm to market. No, that's not necessarily the case. You don't have to spend 5 years working on increasing your EBITDA to get a better offer. You have to spend a good 3, 4, 5, 6 days going, okay, if I did this, this, and this, here's what my EBITDA would look like, and making your case on how it would happen. So as an example, let's say I have to shed X clients, or I have to do this, or do a couple other steps. They can spend a good week figuring this out rather than spending the next 5 years trying to improve their EBITDA, which they should have been doing for the last 5 years anyway and probably aren't getting to. They just need to have a fresh set of eyes looking at this with a different approach, and then bring it to market and see what the market values, what it bears.
This has been a fascinating conversation. I think we could talk for hours more, but I'm going to bring the conversation to a close here and say thank you for everything you've shared here. Thanks to those who've tuned in to the Audit Opinion. I hope this conversation with Bob has helped to shed some light on some of the strategic options available to accounting firms and leaders who are really trying to understand and explore these topics. Hopefully been some nuggets in there and some actionable insights. Whatever path you choose here, though, I would close by saying that the profession is full of opportunity right now. So if you can be deliberate with your strategy, go out there and execute, because there is a world of opportunity like I've never seen before for everybody to take advantage of and to really reposition what it means to be an accounting firm, what services we offer, what value we add to the broader community. So thank you for joining us, and until next time when we'll be diving into another fascinating topic. Thank you, Bob.
Thanks, Mark. Appreciate the time.